Hello, welcome back to Muffet Investment Views. Diageo, LSE, DGE, the global leader in beverage alcohol, fell nearly 9% following their earnings report about a week back. Shares have since bounced a bit. Today we are going to do an in-depth analysis on Diageo stock and see if it is a good stock or not and at what price would it be a good investment. Diageo is a global leader in total beverage alcohol and one of the world's most successful brand builders. Below are some of their products. Smirnoff and Gordon's are some of Muffet's favorite drinks. Diageo is listed in both London and New York stock exchanges. Today's analysis is on the listing at London. They are currently trading at 23.80 with a market cap of £52 billion and their PE ratio is 17 and the dividend yield is 3.43%. In the past 5 years, the price has ranged from 2,100 pence to 4,100 pence and price is currently near the bottom of the range. Diageo is a dividend aristocrat and has grown their dividends consistently over the years and the dividend cover is 1.9. The return on equity is good at 38% and the operating margin is good at 30%. The price to cash flow is 16. Ideally we want this below 10. They have grown their revenues compared to 2020, but for the last 3 years the revenues have stagnated at around £20 billion and the net income was down from £4.4 billion to £3.8 billion. The total debt has gone up to £22 billion and their cash on hand is down from £4 billion in 2020 to £1.4 billion in 2024. This is a negative. They reported in their half-yearly report that the sales in North America was down by 1.5% and the sales in Latin America and Caribbean was down 23%. However, sales in Asia and Europe rose. In total, the group sales value is down 0.6% and the organic sales volume declined by 5.2%. Clearly the raising of interest rates by the central banks to control inflation has had an effect on the sales. In terms of contribution to sales, North America accounts for the majority of the sales standing at 39%, Europe comes next at 29%, Asia Pacific 19% and Latin America and Africa contributing to 9% each. When we look at the sales in each segment, Africa organic net sales were down 13% which they offset with price increases. The North American segment is its largest revenue contributor and they said that the net sales performance was impacted negatively by a cautious consumer environment. The net sales declined by 2%. The Asia Pacific delivered organic net sales, volume, and organic margin growth. Sales grew by 4%. India net sales grew 8% driven by double-digit growth in whiskey and scotch and China net sales grew by 12% primarily driven by growth in Chinese white spirits. The worst performing segment is the Latin America and Caribbean segment where the net sales fell by 15% and they reported a challenging consumer environment. They are expecting gradual improvement in outlook in the second half of 2024. They expect 10 to 20% decline in sales in Latin America and Caribbean and expect profits to fall further although they predict that the rate of fall in profits will be slower in the second half of the year. For the fiscal year 2025, they expect the organic net sales growth trajectory improving and the profits are predicted to be in line with the sales. They are saying that they have a consistent and disciplined capital allocation policy and maintain adjusted debt to adjusted EBITDA of 2.5 to 3 times and a dividend cover of 1.8 to 2.2. What is our take on the stock? Well, we have a stock which is in the consumer discretionary sector which has seen growing revenues and dividends over the years but more recently the earnings growth has stagnated and is now falling. The management has been buying back shares and raising dividends in spite of this by taking on more debt. This is a negative for us. We agree that the current consumer environment is tough and to be honest it might get tougher. Things might get better once the interest rates start to fall but it is not clear when these interest rates cuts will translate into growing sales. Alcohol consumption is discretionary and also the rising awareness of the deleterious effect on health that alcohol has reduced alcohol sales in the West. On the positive side, Diageo has good brands and the sales are growing in Asia, especially China and India. The falling interest rates will help in the future by increasing disposable incomes. Also the share prices which have been overvalued have now fallen to a more reasonable level. However, we think that the risk-reward ratio of buying into the shares at current levels are not good. We still think that the consumers are squeezed by both rising inflation and rising interest rates. Although the Federal Reserve is forecast to cut interest rates in September, this by no means will guarantee rising sales. The PE ratio is still 17 and the sales are expected to fall further. So we advise to keep Diageo in your watch list. No one can forecast accurately how low the share price can go. This may be the bottom but we can't be sure. So we watch how the sales and economy is performing the next quarter. If the share price falls below 2,000 pence, then we think that the risk-reward ratio of entering the stock would be better. These are just our opinions and not investment advice. Please comment on what you think about this analysis and like and subscribe if you like this video.